cafe ambience fading and coffee cup clinking. We're watching gold testing the 4,671.1 level this morning, and right now, retail traders across the board are just piling in.
Yeah, they're absolutely convinced it's this massive breakout. Right?
Exactly. But they are walking directly into a structural trap.
It's the textbook London session liquidity grab. I mean, the retail side is buying aggressively at the exact moment the algorithmic order flow is, well, shifting into heavy distribution.
Right. So stay with us to the end of this 15-minute briefing to get our complete institutional watch list, the exact invalidation levels to protect your capital, and what the New York desk is actually targeting today.
We are decoding the raw flow, cutting through that retail noise, and really isolating the true operational edges. Tuesday, April 28th, 2026. Welcome to the First Coffee by Alpha Road.
And a critical baseline to set before we dissect a single order book today. The data we're breaking down right now is from the preliminary New York session report.
Very important to remember. We are analyzing the raw early order flow before the final bell dictates the ultimate liquidity landscape.
We're looking at the architectural blueprint of the market before the building is actually constructed, essentially. The AlphaRoot desk has run the numbers, and they've isolated a Tier 1 starting lineup.
These are the specific assets presenting a verified, mathematically backed operational edge for the upcoming New York session.
Right, and that list includes the S&P 500, the Dow, the NASDAQ, dollar, yen, gold, and silver. So I want to launch straight into the U.S. indices, starting with the S&P 500.
Let's do it.
Because the desk has detected a highly specific operational edge here under a normal flow regime.
And that regime identification is arguably more important than the price itself.
Really?
Oh, absolutely. Normal flow tells the algorithms that we are not in a trend expansion environment. The market is bounded. It's seeking mean reversion within a defined structural box rather than, hunting for new price discovery zones.
Which frames the current price action perfectly.
Right.
We're trading around the 7,141.7 handle. But the center of gravity for this entire setup, the anchor the desk is obsessed with, is the sweep of the previous day high at 7,178.6.
Right, and that 7,178 sweep wasn't just a casual tick above a line.
No, it was a targeted absorption event.
It was a classic hunt. When you have a clear previous day high at 7,178.6, the order book accumulates this massive cluster of buy stop liquidity just above that level.
Which is mostly retail stops, right?
Yeah, the stop losses of early short sellers mixed with the breakout triggers of momentum buyers. So the institutional algorithms push the price precisely to that level, trigger that avalanche of buy orders, and then use that manufactured liquidity to quietly fill their own massive block sell orders.
Wow. They need that buying frenzy just to get their short positions filled without causing a price collapse.
Exactly. They absorb the liquidity and then the price rejects.
Which leads directly to the primary action the New York desk has assigned to the S&P 500 today, which is an execution on trigger reversal. The base case is a measured reversion back down into the established value range of 7,140.1 to 7,178.6.
But to execute that reversal properly, you have to navigate a glaring contradiction in the underlying data.
The contradiction being the structural bias versus the alpha.
Right. The overarching structural bias is explicitly bearish, and the New York priority action is to sell. Yet the alpha algorithm is currently calculating an 84.8% buy alpha.
And this is exactly where I want to pause and dissect the mechanics. Because if a junior trader glances at a dashboard, sees an 84% buy signal, but the directional pressure shows negative 0.310.
Which is strong selling.
Right, which is strong selling. They're going to freeze. So how does the desk reconcile an 84% statistical buy edge with overwhelming structural selling pressure?
It basically comes down to the time horizon of the specific metric. The alpha calculation is highly sensitive to immediate micro-level momentum.
Okay.
Following a sweep like we saw at 7,178.6, there is often a short-term, localized bounce as the market digests the absorbed liquidity.
Ah, so the alpha is detecting that micro bounce.
Yes, exactly. But the directional pressure, that negative 0.310, is a broader volume-weighted delta. It's looking at the macro institutional distribution.
So essentially, the alpha is seeing the ripples, but the directional pressure is seeing the tide.
Precisely. And in a normal flow regime, the tide wins, but it takes time.
Right.
If we were in an expansion regime, that strong selling pressure would translate into an immediate violent breakdown. But because the context is bounded, the institutional play is to let that 84% micromomentum exhaust itself near the upper boundary of 7,178.6, confirm the rejection, and then align with the heavier selling pressure.
So you ride the reversal back down into the core range. You're trading the boundaries, essentially fading the extremes.
Exactly.
And the New York Priority Guide makes this explicit. It says, prioritize rejection and return to range. Seek confirmation before execution.
It's a mandate to avoid predicting the top. You wait for the market to prove it has exhausted the buyers.
And the risk management parameter here is definitive. The entire short thesis is invalidated if we see sustained acceptance above 7,178.6.
And we need to be clear about what sustained acceptance actually means in the order book.
Yeah, it's not just a quick wick, right?
No, it is not a quick wick on a 15-minute candle that pokes above the line and immediately retracts. Acceptance means the volume profile shifts. It means we see heavy transactional volume occurring above 7,178.6, and the bid-ask spread stabilizes there.
So if the market collectively agrees that price is the new fair value, the normal flow context is completely broken.
And if that happens, you cut the short. The institutional mistake highlighted in today's report for the S&P 500 is fighting the structure bias.
Which makes perfect sense.
Okay.
Let's apply that same structural lens to the Dow, the US 30. We are currently holding around 49,282.8. The context is identical to the S&P, it's normal flow.
Right.
The action is also flagged for a reversal, but the operational execution is entirely different. The desk has the Dow explicitly in wait mode.
Because the Dow is giving us the same fundamental narrative, but the algorithmic clarity just isn't there yet.
The key level that was swept was the previous day high at 49,357.2.
Yeah, and the base case remains a reversal back into the core value area between 49,025.8 and 49,357.2.
But the alpha on the Dow is sitting squarely at 37.5%.
Which is the definition of neutral.
Right. The pre-market decision leans bearish, and the directional pressure is negative 0.251, which is strong selling. So we have the macro pieces for a short, but we lack the immediate statistical edge to actually pull the trigger.
Which is exactly why the mandate is to wait. I mean, institutional capital does not execute on neutral alpha. The S&P 500 has the mathematical edge aligning with the structural trigger, but the Dow is essentially a coin flip at this exact moment.
So the institutional mistake flagged here is trading without edge or without confirmation.
Exactly. When your proprietary metrics are neutral, stepping into the market is just gambling on the macro bias. You sit on your hands until the probability matrix forces you to act.
The invalidation for the Dow is sustained acceptance outside that 49,025 to 49,357 range. Until it breaks out or clearly rejects from the high with shifting volume. It's just a spectator sport.
Totally agree.
Paper flip. Now this brings us to the most complex piece of the U.S. equities puzzle today, and that's the NASDAQ, the U.S. 100. And just a reminder, we are still analyzing the preliminary data run here.
The NASDAQ is presenting a beautiful divergence from the broader indices. While the S&P and the Dow are operating under mean reversal setups, basically bouncing off their ceilings, the NASDAQ is structurally heavy.
The desk has flagged it for a weight breakdown scenario. We're trading right around 27,164.9. The context is still normal flow, and the alpha is mirroring the Dow at a neutral 37.5%.
But the anchor point here isn't a prior high.
Right. The key level is 27,296.2, which is the previous day low. The Alpha Root report explicitly labels this level as a liquidity objective.
Which is essentially an algorithmic magnet. The institutional modeling sees a massive concentrated pool of stop losses resting just below yesterday's low. The market naturally wants to drift toward that pool to consume those orders and generate liquidity.
But the critical diagnostic note from the desk is that price is inside yesterday's range. The NASDAQ hasn't initiated the sequence yet.
Exactly. It is coiled inside the previous day's value area. The base case is a post-breakdown continuation below 27,296.2.
But the New York Priority Guide is aggressively defensive here. It states that NY action is aligned with bearish continuation only with confirmation below range low.
That confirmation requirement is paramount. If you attempt to front-run the breakdown and short the NASDAQ right now at 27,164, you are anticipating a structural break that hasn't materialized yet. You're just guessing.
And if the price drifts down to 27,296.2, hits the liquidity pool, and violently rejects upward, which you said is highly probable in normal flow, you're trapped in a terrible short position.
At the absolute bottom of the immediate range, you have to let the price pierce the level, fail to bounce, and then prove that the sellers are willing to aggressively offer the market below that old low.
The invalidation level is literally the trigger level itself. Sustained acceptance above 27,296.2. If it cannot hold the breakdown, the setup is dead.
The recurring theme across the entire equities complex this morning is patience. The market is testing the discipline of the risk manager, demanding confirmation at every single structural boundary.
Well said. Let's take a quick pause before we dive into Forex and metals.
This is a preliminary briefing. For the final validated 9:00 a.m. report, visit alpharoot.versell.app.
All right, we're back. Let's shift the focus to the metals and Forex markets because the algorithmic regime changes drastically here. We are stepping out of the bounded normal flow environment and entering the highly volatile expansion zone.
And expansion regimes require a completely different psychological and risk management approach.
How so?
Well, in normal flow, you are fading the edges, expecting the market to revert to the mean. In an expansion context, the market has decided to aggressively seek new value areas. You're no longer fading the edges, you're looking to align with the directional force.
Which brings us back to the asset we highlighted at the very top of the briefing. Gold. We're trading around the 4,599.8 handle. The context is expansion. And the alpha is printing a staggering 100% sell.
Yeah, seeing a 100% directional alpha is rare.
It really is.
It indicates that every single proprietary momentum, volume, and volatility metric the desk uses is perfectly aligned to the downside. The pre-market intraday decision is heavily bearish.
But having the edge and having the execution trigger are two very different things, right? The desk has outlined the action as a setup, waiting for a trigger on a breakdown.
Right. The key level here is 4,671.1, and the vital context the report provides is that this was the London high, and it has already been swept.
And that dynamic requires a deep understanding of how global liquidity chains together.
Absolutely. London is where the heavy institutional volume enters and aggressively expands a range, often specifically to trap early directional flow. The report notes London already expanded significantly.
Meaning, London pushed the price of gold aggressively higher, punched through that 4,671.1 level, swept all the early morning buy stops, and then completely exhausted its buying pressure.
New York is inheriting a market that has already fired its primary bullish weapon and failed to hold the ground. The algorithms recognize that the upside liquidity has been harvested, leaving a massive void to the downside.
The setup is perfectly primed for a collapse. But, and the desk makes this abundantly clear, you cannot just blindly hit the bid.
No, the diagnosis explicitly warns that the primary institutional mistake here is trading without confirmation. The base case is a post-breakdown continuation, but strictly below the invalidation line of 4,067.1.
So that 4,067.1 level is the risk manager's line in the sand. If the price of gold manages to claw its way back up and establish sustained acceptance above 4,067.1, it completely invalidates the bearish continuation thesis.
It would mean the London sweep wasn't a trap at all, but rather genuine institutional accumulation.
If the volume profile shifts and begins accepting higher prices above 4,667, that 100% sell alpha immediately becomes irrelevant. Let's look at silver, because it's mirroring the gold narrative, but the statistical edge isn't quite as absolute.
Silver is trading around 72.79. The context is also expansion, but the alpha is sitting at a 67.6% sell.
It's a significant statistical advantage, but it lacks that overwhelming consensus we're seeing in gold. Silver also swept its London high at 74.63.
And the operational framework is identical. Wait for the trigger on a breakdown. The base case is a post-breakdown continuation below that 74.63 level.
And the invalidation is sustained acceptance above 74.63.
Exactly. The risk manager rule for the metals desk today is essentially, London did the heavy lifting, do not chase the ghost of that move. Let the downside setup form organically, and let the price pull its own trigger.
Let's pivot to the Tier 1 currency pairs, starting with a setup that offers immense clarity. Dollar-yen.
USDJPY has been the focal point of immense macro volatility, but the order flow today is structurally pristine. We are trading around 159.66. The regime is expansion, and the bias is overwhelmingly bullish.
The alpha is an 83.8% buy. We are positioned for a breakout scenario. The anchor level that was swept was the previous day low at 159.09. This is the exact inverse of the gold setup.
Structurally, yes. The market drove down into the previous day's low at 159.09, absorbed a massive concentration of sell-side liquidity, violently rejected that lower pricing, and is now impulsing higher.
The pre-market decision is bullish, and the report notes that London has already expanded significantly to the upside. The base case here is a post-breakout continuation above 159.59. That is the execution threshold.
And the invalidation parameter is sustained acceptance below 159.59. If the market cannot hold the higher value area and slips back below that line, the bullish momentum is dead.
The mistake to avoid, yet again, is trading without confirmation. Now, let's contrast that pristine clarity with cable, the pound-dollar pair, GBP USD. We're trading around the 1.3483 handle.
The context shifts back to normal flow here.
Right. The bias is bearish, and the alpha is a solid 72.9% sell flag. We are waiting for a trigger breakdown.
The anchor level swept was the London high at 1.3533. On the surface, this looks like a perfect, clean, short setup. The pre-market decision is intraday bearish, and the base case is a post-breakdown continuation below 1.3497.
But when you dig into the diagnostic data, there is a glaring, massive red flag.
Yes, there is.
The directional pressure metric is reading plus 0.581. The Alpha report explicitly classifies this as strong buying.
This is the ultimate order book contradiction. You have a bearish macro bias, a strong sell alpha, and a swept London high that suggests upside exhaustion. Every traditional technical indicator is flashing red, but the actual volume-weighted directional pressure is heavily positive.
Institutional capital is aggressively absorbing the sell orders and accumulating the pound in real time. So how does a risk manager handle that conflict?
If you execute the short, you're fighting massive buying pressure. If you execute a long ERBA, you are fighting the statistical alpha and the structural bias.
It's a mess.
You handle it by doing exactly what the New York Priority Guide demands. NY action is aligned with bearish continuation only with confirmation below range low. You force the market to resolve its own contradiction before you deploy a single dollar of capital.
You let them fight it out. If that strong buying pressure is genuine and sustained, the price will remain elevated. It will never break down below the 1.3497 trigger level, and you simply never enter the short trade.
But if the overarching structural weight eventually overpowers that temporary localized buying pressure, and the price drops to find sustained acceptance below 1.3497, then that buying pressure was just a liquidity trap. Your short thesis is validated by the price action itself.
The invalidation parameter is sustained acceptance above 1.3497.
Yeah.
You aren't guessing the outcome, you are executing on the resolution.
Exactly.
And executing on the resolution requires having the most accurate real-time data at your disposal.
Read the full final report at alpharoute.vercel.app.
All right, we've mapped out the Tier 1 starting lineup. Now we need to look at the bench. These are the Tier 2 directional bias assets and the Tier 3 observation assets. These markets have massive potential energy, but they lack a defined, actionable New York session edge.
The bench is where risk managers practice the art of capital preservation. Just because an asset has a strong directional bias doesn't mean it deserves your margin today.
Right.
Institutional capital deployment is ruthlessly efficient. If an asset is stuck in a holding pattern, you don't park your capital there hoping for a catalyst. You observe.
Let's start with the Eurodollar, UUSD. The data here is a masterclass in conflicting signals. The bias confidence is a perfect 1.00. The algorithm is 100% certain of a macro bearish bias. Furthermore, the alpha is printing a 100% sell.
But the execution command is a hard weight. The context is normal flow.
Exactly. We have absolute mathematical certainty on the downside bias, but the pre-market decision is bullish, and the directional pressure is negative 0.157, which is strong selling.
The immediate flow tried to push higher but slammed into a wall of distribution. The euro is caught in a high-volume stalemate. The diagnosis is that the price is trapped entirely inside yesterday's range.
The key level swept was the previous day low at 1.1691. The base case is a tedious intra-range rotation between 1.1691 and 1.1754.
The New York Priority Guide states, no clear NY edge. Stay in wait mode until valid confirmation appears. This is the ultimate test of patience.
If a trader sees a 100% bearish bias
Mhm.
and immediately shorts the euro, they are committing the cardinal sin of trading without an immediate edge.
Being fundamentally right about the long-term direction but completely wrong about the short-term timing is functionally identical to just being wrong.
Wow, that's a great way to put it.
If you short the euro right now,
Mm.
you could sit in an underwater position for 14 hours while it chops sideways between those boundaries, only to get stopped out by a random volatility spike right before the actual structural breakdown happens tomorrow.
The opportunity cost of tying up your capital in that rotation is massive. Invalidation for the euro is sustained acceptance above 1.1754 or below 1.1691. Until it breaks out of that box, it remains benched.
Yeah.
We're seeing a very similar volatility vacuum in the Kiwi, NZD-USD.
The Kiwi is printing a 0.62 bearish bias confidence. The alpha is a 62.5% sell. The context is normal flow, and the action is, once again, wait.
The base case scenario is a rotation. The anchor level is 0.5855, which is the previous day low, and explicitly flagged as a liquidity objective. The price is currently stuck right in the middle of yesterday's range at 0.5876.
The algorithmic expectation is a slow, grinding rotation between 0.5855 and 0.5902. Invalidation only occurs if we see acceptance outside those specific bounds. The market is consolidating, waiting for a macro catalyst.
And dollar CAD, the loonie pair, is in an even tighter, more dangerous structural squeeze. The context here isn't just normal flow. The desk has explicitly labeled it compression consolidation.
The macro bias is bullish, but the confidence is weak at 0.62. The alpha is a tepid 62.5% buy.
The diagnostic note for dollar CAD is incredibly revealing, it says. Bias bootstrap in progress, awaiting confirmation. The algorithms are literally telling us they do not have enough clean data to establish a dominant directional vector today.
The order flow is just too fragmented. The base case is a highly compressed intra-range rotation between 1.3596 and 1.3679.
The priority guide is identical to the euro. No clear NY edge. Stay in wait mode.
Compression zones are notorious retail traps. Because the price is barely moving, inexperienced traders perceive it as low risk. They over-leverage within the tight range.
Which is dangerous.
Extremely. Compression is mathematically guaranteed to lead to expansion. The longer the market coils, the more violent the eventual breakout will be. If you are positioned heavily inside the compression zone when the spring finally uncoils, the slippage alone can decimate a portfolio.
Which provides the perfect transition to the crypto sector, because the volatility compression we're seeing there is historic. Let's look at Bitcoin, BTC-USD. It's sitting in the Tier 2 directional bias category. And despite the massive retail attention, the institutional desk is mandating extreme caution.
The context for Bitcoin is pure compression and consolidation. Bitcoin algorithms are masters at creating these high-tension traps. The market will chop sideways for days, tricking participants into trading the microboundaries, and then it will execute a massive bidirectional sweep of the entire order book in a matter of minutes.
The internal data for Bitcoin today is a complete statistical car crash. The overarching structural bias is bullish. However, the immediate alpha is a 72.1% sell.
And the pre-market decision was bullish, but the real-time directional pressure is negative 0.238, which is heavy, strong selling.
You have macro accumulation colliding violently with immediate localized distribution. It's an untradeable environment for institutional size.
The key level that was swept was the previous day low at 76,433.4. And right now, the price is hovering dangerously close to that level at 76,445.1.
It swept the low, seeking liquidity, but it did not find aggressive, supportive buyers.
That strong selling directional pressure is keeping the price pinned down like a heavy blanket. But because the overarching macro bias remains bullish, the risk managers will not authorize a short execution.
So the resulting action is, wait. The algorithmic base case is a massive, incredibly volatile intra-range rotation between 76,433.4 and 79,464.4. That is a $3,000 range of pure, unadulterated chop.
If you attempt to trade Bitcoin today without hard, validated confirmation, you are actively committing the noted institutional mistake of trading without an edge. You are merely gambling that this massive compression zone will eventually resolve in the direction of your bias.
The invalidation parameters are strict. Sustained acceptance above 79,464.4 or below 76,433.4. Until Bitcoin successfully breaks out of that $3,000 box and holds the new value area, you let the algorithms fight amongst themselves.
You preserve your capital and ride the momentum only after the direction is unequivocally confirmed.
Exactly. We have covered an immense amount of structural data today. Let's execute a rapid 30-second recap of the session's absolute highest probability targets for the active New York desk.
Sounds good.
The primary focus remains the S&P 500 reversal, targeting a return to the 7,140 to 7,178 range, assuming we do not see sustained acceptance above that prior high.
And secondly, the gold breakdown setup, which relies entirely on confirming a structural break below the London high sweep, with strict invalidation if the market accepts prices above 4,067.1.
Those are the validated operational edges. But the true takeaway from today's data is the absolute necessity of execution discipline. And I must emphasize this one final time. All the levels, the alpha percentages, and the directional pressure readings we have just mapped out were drawn exclusively from the preliminary run of the New York session report.
The market order book is highly dynamic. The liquidity pools will shift, and these setups can evolve rapidly before the opening bell even rings. As you map out these levels, ask yourself, are you trading the structure bias, or are you fighting it out of impatience? Wait for the trigger. The market never rewards you for being early. It only rewards you for being right.
If this briefing helped you, subscribe on YouTube and follow us on Spotify, and share this episode to support the channel.
This briefing is for educational and informational purposes only and does not constitute financial advice. Trading carries significant risk. Always validate your own setups.
Cafe ambience fading out. We started this deep dive by talking about the trap of blindly trusting the breakout. Today's data proves that true precision in this market isn't about perfectly predicting the next move. It's about knowing exactly what the algorithms are waiting for before they deploy capital. Until next time, stay patient, respect your invalidation levels, and wait for the confirmation.